Hi, hello everyone. Let's start discussion on a very important topic for the credit risk management. And if you are applying for the credit risk analyst role or the credit risk and quantitative analyst role, so you should know the five C's of credit risk analysis. So that indirect and directly link with that is a probability of default, loss given of default, exposure of default, and that will help you the banks or the non-banking financial institutions or the lender will give some idea on the borrowers. So the five C's of credit risks are the very important and the core pillars of the credit risks. If you are applying for the credit risk analyst role, so you should know these five C's of credit risk. First one is a character, capacity, capital, collateral, and conditions. And we will going detailed discussion on that five C's in a step by step. So let's discuss on the very important things. What are the five C's of the credit risk? So the lender use 5C's factor to evaluate the borrower risk behavior before applying the role. Before sanction the loan or the before borrower will apply the loan, the bank or the financial institution or the lender will check these five factors. So first one is the characteristics of the borrower, capacity of the borrower, capital of the borrower, or collateral of the borrower, or the condition of that borrower. So is that able to pay or not able to pay? So that five C's in detail we are going to discuss in upcoming slides. So, but you should at now this stage you should know that five C. First one is a character, second is a capacity, third one is a capital, fourth one is a collateral, and the fifth one is a condition. So let's move on the one by one of these five issues. First one is the character. So in a character, the we will ask the questions like, will you repay the loan? So the lender will ask the borrower, will you repay the loan, or is the borrower will repay the loan? So that credit history and credit score of that borrower will check, or the credit rating of that borrower will check. So there are the agencies like S&P 500, CRISIL, or the Modi. These are the credit rating agencies that provide the credit rating of that the borrower. Then the payment track record on past loan card. So they we will check there the history of the record on the credit history. So how on is that the borrower will pay timely, or is that borrower has a good history, good time of the history, how much the existing loan that borrower have. So that thing we will check in the character and the reputation and trustworthiness and the reference and the income we will check in the characteristics. And lender asks, can we trust this borrower? It's the most important thing, guys. So lender will ask himself, can we trust this borrower, or is this borrower will repay the principal and the interest rate which we charge for that borrower. So these are the things we consider in the character of the five C's of the credit risk. So then let's move on the next character, which is a capacity, and which is and the most important thing, guys, also. So the can you repay the loan? So the capacity will also can you repay the loan? So where we are going to check the income stability and amount, or in the infrastructure debt service coverage ratio we will check the balance sheet of that, or how much for the month if it is an individual employee. So we will check the how much the income he salary he is get in account, and existing debt obligation, what are the current dates he are with him. So and on that basis we check the debt to income ratio, how much the cost he bearing and how much the income he have. So the monthly debt divided by the monthly income, we check for the debt to income ratio. If the monthly debt is 10,000 and the salary is 20,000, so we are not able to give loan him for the 10,000. So it's higher the debt monthly debt to income ratio. It will be lower the debt to income ratio is good. Higher the debt to income ratio is not the good. So larger the debt, so income the less. So let's does cash flow support the new payments? is that the customer's cash flow are supposed to make the new payments or the credit payment. So let's go on the next slide, which is the important, which is the capital. So how much the skin in the game, how much the capital that borrower will have, and how much the capacity of that borrower which will look to pay their capital to the lender. So borrower own money invested in the project businesses, how much the money is invested that by borrower, and how much the future expectation upcoming that money in the borrower hand. So that will check in the capital, and the down payment for the mortgages, equity in the businesses, how much the initial down payment or the equity share of that borrower. So this thing we will check in the capital and show the commitment and reduce the lender risk for once we sanction the loan or disburse the loan. So lender asks what you will lose if this fails. So what lender will ask, how much the amount, how much the percentage of you will lose if the borrower will fail to repay the loan amount or the principal or the interest rate. So that's it comes under the capital. So we will look at the character, capacity, and capital. So next two are pending are the collateral and the condition. So let's move on the collateral side, guys. You should remember that thing, continuously practice 100 and plus time to remember that 5 C's, and you should be speak that 5 C's while you are doing the credit risk analysis interview, because it's impress your and you are separate from the other candidates. So let's discuss on what trigger the loans collateral, on the how much value of the loan we are going to the borrower. So how much the collateral he might be provided us. So asset plays house, car, equipment, inventory, gold loan, or these are the collateral for the borrower for the lender. So that the value of these things will consider by the lender. So lender can claim if borrower is default. So collateral is important for the borrower if lender, if the borrower is default or if the borrower is not able to repay the principal and interest rate for the upcoming period. So in that case, the borrower, the lender will go and seize the collateral property or collateral thing, and recover from that the value of the lender. So reduce the risk of secured loan, and the lender asks what backs this loan if things goes wrong. So what backs and what help them if the things goes wrong. So let's discuss on the last five C's, last five C, which is a condition. So let's discuss one by one C. So first one is a character, second one is a capacity, third one is a capital, fourth one is a collateral, and fifth one is a condition. So let's discuss on the condition. So what's and the purpose and the environment for that conditions, and is that person is eligible or willingness to pay the loan amount and the loan return in the principal and principal amount and the interest rate charged by the bank. So purpose of the loan: expand business, home loan, to buy the car, to gold loan, or the personal loan, or the term loan, or the infrastructure loan. So these are the different purposes for different objectives that a borrower will wants to achieve. So he will get the loans, and the condition, the economic condition, interest rate, industry trend, or the market conditions that we need to check in the condition side. So he is able to the on that economic terms is able to pay the principal and the interest rate charged by the borrower. So sorry, by the lender, not the borrower. Okay, it's against the borrower. So loan term, amount, interest rate, and the tenure, how much they have. So it's a condition. How much the amount of that loan, how much the interest we are going to charge, and what is the duration or the tenure for that. So our lender asks, does this loan make right sense to right people, or does this loan make sense to right now? It's the good loan or it's the covering loan. So let's discuss on the why the 5 C's matters most important for in the perspective of borrower and in the perspective of lender. So let's discuss in the perspective of borrower. So it will improve the approval chance for the borrower if all the 5 C's are good, and it will be share that the borrower is a non-defaulter and it will pay your principal and interest rate. So we will immediately approve the loan. We will get better rates or the lower rates for such kind of borrower and understand the weak areas of that borrower, and accordingly we take the immediate action on that. So that's will for the borrower perspective. Let's discuss on the for lender perspective. Reduce the default risk. So there is a huge chance that the borrower will default and the bank or the lender will lose their the entire investment. So the that five C's, which one is which are the character, capacity, capital, collateral, and conditions, will help them to reduce the default risk. Then make a consistent decision. It will always help them to make a continuously and consistent decision, and the price loan correctly. So the price of that loan or the value of that loan, how much we are going to give the principal, so that will help to the correctly value of that thing. So these are the five C's that matter. So let's once again discuss the what are the five C's. First one is a character, second is a capacity, third one is a capital, fourth one is a collateral, and the condition. Character, capacity, capital, collateral, condition. You should remember that thing, and accordingly you will able to discuss. So lastly we are going to discuss one of the example, which is the important example for guys you. So applying for 20 lakhs business loan. So let's consider if you go to the bank and if you are able to apply the banks for the 20 lakhs the business loan. So they will check in the character side your civil score is 780 and no miss payment is you are do any mispayment, or if you are delay in the payment, or what is your civil score. So that's comes under the part of the characteristics. Then the capacity. So, so the monthly profit of yours is 1.2 lakhs. So, which is a good, and 25K existing EMI with DTI is a 20%. So that's with the capacity, how much you can pay the monthly, your overall cost, and if any uncertain event or the mergers event will happen, so how much you will pay in that condition. So that will calculated in the capacity part. So then the capital, if the 5 lakhs own investment in a business, if how much the capital of your own you are going to invest in that business. So where we consider debt to equity ratio, how much the debt you want and how much the your own capital you are going to invest in that projects. So 5 lakhs is own investment of your business. If you suppose if you have the uh, if you have the 20 lakhs crore of your business value of your that business investment required, and if you 5 lakhs you have, so you have the 5 lakhs, the 20 25 25 the debt to equity ratio. So that's the capital and the collateral. So business equipment worth is 15 lakhs. So what are, if you once if the banks or the lender finds that in certain states you are not able, if uncertain condition or the risk condition, you are not able to pay the principal and the interest rate. So what are the collateral value? How much the bank will recover from that? So that value might be 15 lakhs, 10 lakhs. So bank, if it is a 15 lakh, so in that case, bank will, no loss, because you already invest your 5 lakhs and bank will give you the 15 lakhs loan. So bank will no loss. But if it is a 10 lakhs value, the collateral value is 10 lakhs. So in that case, bank will lose the 5 lakhs upfront. So the value of the collateral is higher, the bank will secure the more, and bank will charge the rate of interest is low. Then the condition, expanding into the growing market. So the condition, it will always expanding the growing market and find the new opportunities. And the result, low risk likely approval. So if they suppose there is a low risk and higher payment capacity of that, so it will approve the loan. So let's once again discuss 5C. First one is a character, capacity, capital, collateral, condition. Character, capacity, capital, collateral, conditions. So thank you so much guys for attending this interesting seminar. It is the end of this seminar. Once again, thank you so much guys.